wanted to help explain how banks really work. And one way to do that is to just look at the common debit card and the fact that they call it a debit card, because the truth is that it controls a liability account of the bank. It's not a savings account or checking account, wherever those things are supposed to mean. It's not something in a vault that the bank is holding for you. A quick accounting lesson is that if you have an asset, if you're running a business and you have an asset, just like a cash account or land or whatever inventory, if you're going to increase it, you will debit it. Like you got inventory, so you're going to debit it, and maybe you would credit cash because you paid cash. But the inventory account is going up, so you debit it. If you want to reduce it, you would credit it, right? So if you use up some of the inventory, you would credit that account. They tell us to use a debit card to withdraw from our account, which reduces the account balance. Then it's not an asset because a debit would increase an asset. But if we look at the other part of accounting, a liability, if you're going to reduce a liability, you would debit it. You use your debit card, you are reducing the balance of what you think is your account. I mean, it is your account in a way, but it's not really your account. And so you're using your debit card to reduce the balance. You take out $100 and it's reducing. If it's an asset account, it would be called a credit card, because if it's really your asset account, you would be crediting it to decrease it. But instead, you're debiting something. What are you debiting? You are debiting a liability account of the bank, because the truth is you lent money to the bank. You loaned it to them and they owe it to you. When you withdraw some of that money, they owe you less. And therefore, since they owe you less, their liability has gone down. And so they are going to debit your accounts payable, like, just like they have accounts payable to the cleaning crew, the vendor that works on their air conditioning. Those are all accounts payable accounts. Like they've been invoiced by the air conditioner and they owe a certain amount to the air conditioner. And when they increase that, it would be a credit. When they pay the air conditioning company, they would debit that accounts payable account because they want to reduce it. So getting back to what we think are savings or checking accounts, they're really just, we lend money to the bank and the bank owes us that money. So when we withdraw some money, we're debiting that accounts payable on their books. Now, what gets interesting is the next thing I want to talk about is, okay, then it's just to segue into what loans are. Do banks loan money? And you might have seen I did a transcription of a famous economist who knows what banking was really going on. And I want to segue to loans. So as this man explained, banks don't loan money. When you fill out a loan application, you are promising to pay, let's just say, $500,000 with 10% annual interest, right? So that's an IOU. You could give that to anyone. I promise to pay. It has, just irrespective of what somebody else is giving you, and you think you're getting a loan from the bank, right? So that's why you're writing them an IOU with interest, because you think they're giving you something. But just on its own, that loan application is a promise to pay back what you think is coming plus interest, right? So there's value there. It's like, just on its face, it says, I'm going to pay whoever holds this $500,000 plus 10% interest until it's all paid off. So what the banks do is they promise to buy that IOU. I know it's crazy, but that's what they do. They promise to buy it. They don't even buy it. They just promise to buy it. And the reason why is, so then you give them that, and they have an accounts payable. They also take possession, but they promise to pay you later, like anything else, like taking inventory, right? They promise to pay you later. It's just like getting a new vendor for your business. Like, oh, all right, so it's a new vendor, or I bought an IOU for someone. Who is it? It's someone new. Okay, let's create an accounts payable account. You create a vendor account, and you owe them. You promised to pay them, to pay $500,000 for that IOU, the loan application. And so you put a $500,000 as a vendor account, as a accounts payable. So that's what a loan is. And to prove it, they don't like transfer money to your account. Let's just say you go to the bank that you've used for years and you say, I'd like to borrow $500,000 to buy a home. So they don't. If it was truly a loan, they would just move $500,000 into the account you already have, but they don't do that. And I know they don't do that because, this man said, and I also went to a local bank of mine and I was like, do you guys move the money into the account? They're like, no. What they do is they create a new account, just like I've said. It's considered like a new vendor, and it's just an accounts payable. So the banks, the long story short, the banks don't lend you money. You are paying interest. You are paying them a fee for nothing. You are simply, in essence, what you are doing is you are getting like carnival money. Like if you go to a carnival, like the different games that you can play, or to squirt the water into the clown's mouth, you need to give them a ticket. And they don't accept money, right? So they accept tickets. So you get the tickets at the gate, or you keep getting more from the carnival. So that's what you are, in a sense, getting from the bank. You're getting Federal Reserve. They're all part of one system. I know it's like seems like different banks, but they're all part of the Federal Reserve System. So they're just sort of like franchises of the Federal Reserve. They compete with each other, but they're still part of the same organization, and they give out Federal Reserve notes, and we use them just like in a carnival. But they've turned the whole world into their carnival. It's so sad, and we pay a fee to use these carnival tickets. It's outrageous. And get this, they create more carnival tickets anytime they want. Well, really, the government is in cahoots with it because they want low interest money. Anyway, so I hope this is helpful. So just getting back to the beginning. So as you can see, actually I didn't even go into this, but you can see right here on this chart, you can see that assets, you debit assets to increase them. So if you get more cash as a business, you are going to debit. But they tell us a debit card to withdraw cash. So it's really their books. Like the whole thing is their books. Once you get that in your point, like you are just like, it's like sometimes I might call a business to be like, how much do I owe you? Like, I just want to reconcile. It's like at the end of the month, like I'm showing I owe you 10,000. What do you show? And they're going to look at my account, which is an accounts payable for them. And that's what bank accounts are. So now you've learned today what bank accounts are. They're really loans to banks. And you've also learned what loans, that banks don't really loan money. They just promise to pay you, and you get their sort of carnival money called Federal Reserve notes. So what's the solution? Solution is start using anything else as money, and you start. It's challenging, so I won't get into that. But you can use copper and gold and silver for indirect trade right now, and you just have to sort of take yourself out of that carnival that they want you to be a part of, and there's huge fees associated with it.